Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, May 24th, and then we'll see how things look for Thursday, May 25th. We had another down day. We've had back-to-back down days now, so this market may be at the point where it's going to have to go lower, hit some support, see what things are like at that time, and then possibly turn and go up. Or is what we're seeing going to be something that turns into something else that is a lot more negative? We just have to take it day by day and evaluate where things are at. Now, before I get going, I do have a supplemental video that you're welcome to watch. I posted it about 2.5 weeks ago, but it's still very relevant to what's going on right now. I do have a PDF of all the slides and charts that I use in this video that you can download and look at. And my hope is that this will overcome any of the problems that some of you are having actually being able to see the charts. Please try looking at that PDF and see if that helps. If it doesn't, contact me. We'll try to come up with another alternative. I do have a private Facebook group, and again, welcome to all the new members who have joined over the last few days. I do have a poll that's posted on the community tab on my YouTube channel. Please feel free to take part in that. And also know that I post not only to YouTube, but I also post to Rumble. If you can't find me for some reason on YouTube, please switch over, go to this channel right here, and there should be a video available there. All right, let's go back and talk about what happened. We did have a gap lower open with prices falling below S1 at 41.30. We also fell down below S2 at 41.15. As the day went on, prices just chopped above and below S2. There was an attempt at a rebound later on, but that failed. My understanding, it was some kind of a buy program that came in and spread across all the different sectors. Selling came in and took prices back down, and we closed a bit off of the low. We were down 0.73% on below average volume. That could be somewhat positive if you're bullish right now to see a decline like we saw with volume actually dropping off. The technicals are switching more negative now. A lot of this has to do with the debt ceiling issue, and that will get resolved one way or the other over the coming days or week or so. There's still a real standoff going back and forth. They're using their political posturing to try to dig in their heels and say they want this, they want that, while they hold the market and the whole country as a hostage right now. But that's what politicians like to do. My personal take on this is that I don't think we're going to end up defaulting. That would send a really negative message to the rest of the world, and to try to use that as some kind of a political posture, I just don't see that happening, and in the end, they should try to be able to come to a conclusion on that. What are some comments that we can make? There's still a lot of this uncertainty about the debt ceiling. There's no real deal that's coming out right now. Both sides are not even close based on what I'm looking through. Also, we had some Fed speak. Governor Waller said that we need to maintain flexibility on the best decision to take in June. How's that for being very non-committal? He also went on to say fighting inflation continues to be my priority. Then the meetings were released from the FOMC meeting that took place on May 2nd and 3rd. There wasn't anything that really caught the markets off guard, so we didn't see a lot of gyration. Everybody on the committee agreed that inflation still remains too high, and that the economic data that's been coming up shows that inflation is declining, but not as fast as they had hoped. Also, it was stated that participants expressed uncertainty about how much more policy tightening would be appropriate. We're still getting closer to that 4,100 level, which has been providing support when we've come down to that level before. If we come down there, will that be a launching point, or are we going to fall through that? If we do start to go back up to the upside, we're still really battling with that 4,200 level. On a short-term basis, we already have one of our indicators that is extreme negative, the Stochh RSI. And in the intermediate term, we have the McClellan oscillator, which really hadn't shifted back much more positive, but now it's dropping down to being extreme negative. The dollar was up and interest rates were also up, and this could have provided some headwinds. And the rebound that we're seeing in the dollar is kind of interesting, and I have a chart to show you later. We still have the yield curves that remain inverted. Sentiment is still positive. It ticked down from 66, where we came in at 61. Our trend, it's still positive, but that green line is really coming down. I'll show you the chart. The ADX is just barely above its moving average, but both are still below 20. I've changed our bias to negative, and now our momentum is also negative. The economic reports that came out, we had the weekly MBA mortgage applications index. We just keep an eye on this because that deals with the housing sector. Purchasing applications were down 4%. Refinancing applications were down 5%. The whole index was down 4.6%. Some Isabel net charts. This is an interesting chart that we look at about once a month. It's the truck tonnage index and how it correlates with what's happening in the market overall. The purple line is the S&P 500, and that's been holding up fairly well, although we've seen some recent weakness. But the tonnage index is really starting to go down. These two have a tendency to go in the same overall direction and usually don't get that far apart from each other. Also, we're looking at monetary policy conditions, and then we have the S&P 500 here in blue. These are different events that have happened, and then what monetary policy did after that. It's kind of a historical chart. Then we're also looking at the advanced decline line, which we've been talking a lot about. They're saying this is more positive, where it's more of a rounded bottom here. This could be a bullish setup, but as of right now, the advanced decline line is lagging the S&P, which is what I've been talking about in each video. When you put these patterns together, it suggests that the risk of a late May dip ahead of a summer rip. So they see more weakness and then eventually going forward. Also, we look at this about once a week. Are you going to increase or decrease your exposure to stocks? That's equity. And it had been at 35%. It went back up to 38%. Then what are the cumulative fund flows across the different assets? Most people are still putting their money into money markets. Not so much to make it a parking spot before it goes into the stock market, but just because they're yanking their money out of the banks because they're paying still next to nothing, and they're switching it over into a money market, which is much more attractive. Then in second place, we have government bonds. We're seeing a real pickup in that. Folks are still a little bit leery about getting into stocks, which is equity. And then corporate bonds, which aren't as flashy as other things. We're actually seeing a bit of a decline there. This is looking at systemic strategies. That's when you follow a system and you don't deviate from that. You compare that with a discretionary strategy, which is where, okay, this is looking good, I'll buy. This is looking bad, I'll sell. Ooh, look at this stock over here that I never bought before. You can make different choices. Well, when we look at the green line, the systemic strategies are doing better right now as the market's been improving. The overall is just barely under zero, and discretionary, because we're seeing a real choppy market right now, so people are dashing here, dashing there. In those kind of choppy environments, they tend to follow what's already happened, and then they end up arriving too late, and so their returns end up being a lot less. Where when we're going straight up or straight down, people can get into it and ride that for a little while. This chart looks at quantitative easing and then adds the treasury issuance, the things that they're issuing out of the treasury, against the S&P 500 PE ratio. The red line is how quantitative easing is really taking money out of the system, but the PE ratio keeps going up. Are we seeing a disconnect here? Getting into our charts, first of all, we gapped lower below S1, and then we quickly went down to S2, and then we just danced along this S2. We went down a little bit, up a little bit, but we just kind of stayed right at the S2 area. This is when that buy program came in, tried to take things higher, but nobody else was coming in to reinforce that. So then we saw some late day selling, and we finished just a bit off of the low. The intraday chart, where we had been more positive in the initial overnight session, once Europe opened, things turned a lot more negative. We had a negative opening. And then after the market closed, we're seeing a bit of a recovery going on in the initial overnight session. Large cap growth continues to outperform large cap value. Overall, the green line is above the red line, even though they're on different scales. But one thing that was also positive is large cap growth was down less than large cap value. The same thing with the mid caps and the small caps. And then this is interesting. We had a down day yesterday, but look at the growth versus value intraday. Now it's chopping all over, but it is going up overall. So this suggests that some of the smart money is coming in and they're buying growth, just like we're seeing in the small and mid caps. And they're doing this when there's weakness in the market. This might suggest that we have a dip in May because the real smart money, they know this stuff. They invented this stuff. And so they know that May is going to be a lot weaker. So why not buy at lower prices? And so they're going in and buying some of the growth stocks now. We need to see, will this continue? Will this eventually feed over into some kind of positive action in the market? Looking at sentiment, we turned up a little bit with the Ulcer Index, but we're still very low overall. With the down day, the VIX did shoot up a little bit. We're getting back up to that 20 level on the line chart, and we're also breaking above but closed slightly below it on the bar chart. The volatility of the VIX is picking up as we've been going down. And I haven't shown this for a few days because it really wasn't telling us anything. As we've been going down, the 5-period simple moving average of the equity put call ratio continues to decline. Now, we're not coming off of a recent signal. The signal that we got was a while back now, but the fact that this is declining overall, it's just showing that folks are not really hedging their positions right now, meaning that they have confidence that the market should go up. Now, this is a 5-period simple moving average. We were up for the equity put call ratio as we've been going down, but this is just showing that the overall trend continues to decline. Looking at our other fear gauge, we're pretty much chopping sideways. We ticked up a little bit with this fear gauge chart. The other fear gauge chart also ticked up a little bit, and we've been going up overall for the most part. This is another potentially positive thing. We're seeing a real shift going back into the risk-on type of environment. We're waiting to see if that will continue. Advanced decline line, with the down day, we decline based on price and volume. As I keep pointing out, on a shorter term basis, there's a negative divergence here because volume is weaker than price. And longer term, we also have this negative divergence. New highs, new lows did turn back down. As we've been falling, we're starting to create some new lows. So our 5-period is rolling over and our 10-period is just starting to decline. We're falling below the 0 level with our advanced decline ratio. Accumulation distribution is still a little bit above this moving average, but it is showing some weakness. Then we're still seeing these longer term negative divergences. See the cumulative advanced decline line? It really dropped off on Wednesday, and the advanced decline line is also falling, which leads me into this next chart where we had been holding up above this trend line. Now we're starting to slightly break down below that. We'll be watching this as well. Then we have a longer term negative divergence between common stock based on price as well as volume. Broader measure, the NYSE is now dropping further below its moving average. The S&P has fallen below the moving average. The mid caps are showing weakness. The small caps never got up to the moving average but are now coming back down. Looking at our trend, this is where we're seeing the ADX just barely above the moving average right now. Another weak to sideways day and possibly even somewhat of an up day, and this could cross over negative. The green line is on top, but it is really coming down as the red line's coming up. Volume was below average and continues to be low overall. Looking at our short-term analysis, we came up to this resistance level and now we've been falling down. We're coming down more to this pivot level. I know that's a little hard to see. And then on the bottom, it shows where we did drop below average with volume. I haven't shown this in a while because it's been stuck pretty much in the middle. The 20-period, 50-period, and 200-period exponential moving averages are showing a decline but not giving us an extreme reading. We're falling well below the 20-period simple and exponential moving average. That has turned the short term more negative. Our Stochc RSI has already gone extreme negative. Just a day or two ago, it was extreme positive. You can see how touchy this indicator can be. Our stochastics not getting anything extreme right now. We're more negative in the short term. Intermediate is turning down, and we're rolling over with the longer term. We're coming back into the top part of the rainbow in our short-term moving average rainbow chart. The force index has now dropped below 0. That's more negative in the short term. Looking at the intermediate term, the balance of power is still below the dashed line and declining. Looking at our double and triple exponential moving averages, we've now closed below both 50-period moving averages. The go-no-go system remains more neutral with the lighter colored blue bars. And we're watching this level at about 40.78 to 40.79. If we start to fall, will that end up be providing support? That kind of lines up with that 40.80 level that we're seeing based on the Commitment of Traders report, showing that if we drop below that, a lot of those E-mini folks may need to get out, and that could really put some pressure on the market. The TTM squeeze is also showing a little bit more weakness. And we're still coming down, but we're above all of the moving averages in the intermediate term moving average rainbow. Our PPO studies, we're still positive long and intermediate term. We're starting to go negative in the short term. Our RUN has not changed, and it's still positive. The McClellan oscillator just barely coming down into this extreme negative reading when you look at just the S&P 500. And then when you look at the NYSE, it's also turning more negative. The summation index based on price continues to decline. And we've also now turned down based on volume. I posted something yesterday saying, will volume bring price back up, or is price going to suck volume back down? So far, it looks like the price going lower is also now having an influence on the volume. Swenlin trading oscillator, after looking kind of positive yesterday, has now dropped below zero based on price. We're still above zero based on volume. The PMO, after barely crossing positive, is now starting to shift back down. We're still negative based on price, and we're still barely positive based on volume, but it is rolling over. Our PMO study shows a real weakness in the PMOs that are rising. We're turning down with the buy signals, and we're also going lower with the PMOs that are above zero. The Elder Impulse system for the S&P remains negative. The parabolic SAR, this is positive. We haven't gone down enough yet for a dot to turn over and go on the top. If we see any more weakness, that is likely to happen, but it hasn't happened yet. The slope indicator, which had been positive, is now starting to roll back over negative, and the MACD is also starting to roll back over negative. Here's all of our oscillators. We already talked about the slope and the MACD. The TSI is turning down. The PMO is also running into some trouble. The PPO is already negative in the short term that we looked at. We're turning more positive with the tricks, and we're trying to cross barely above the moving average with the KST. Those are our longer-term oscillators. Looking at the 50-period moving average, we're still above both of them, but we're coming down to the exponential moving average. The more important one would be the red one, which is this simple moving average. We're coming down below the 20-period moving averages in our moving average tree and starting to deal with the 50-period moving averages. The bullish percent index, after showing some improvement, is now coming back down, but we're still above 50 overall. The NYSE bullish percent index continues to be below 50 and declined. The Chaikin money flow is still holding up fairly well right now. This tries to measure institutional buying and selling. And this could get into that growth area where it looks like the smart money might be going in and purchasing growth stocks. That's being picked up by this indicator, at least for right now. The Chaikin oscillator, though, it is starting to turn more negative. That's intermediate term. The money flow actually turned up a little bit and is just barely above 50. The ultimate oscillator is declining, but still above 50. The vortex actually ticked up a little bit on a down day. That's interesting, but it's positive overall. I wanted to show the RSI charts because on the 14 and the 9 period, we're starting to drop below 50 on both. On-balance volume continues to be more negative. We're still seeing this real negative divergence when we look at those stocks inside the S&P above their 250 period moving averages. The Copic curve still has a buy signal, but it's starting to roll over a bit. And this is interesting. The Pring bottom fisher in another day or two could potentially generate a buy signal. Looking at our line studies, we're still below this 4170 level. Now if we start to go back up, that may act as resistance. We're falling below this 100% retracement level. We're just barely below it, like 8 points. If we go back up, that may provide some overhead resistance. Longer term, we've fallen below the 4156 level. Longer term, if we continue to fall, this chart suggesting 4020 might offer support. And then we're also showing how we're bouncing off of this upward sloping trend line here and coming back down. And then we're into the new 50-day cycle. We topped out last Friday, and that could be suggesting a shift in the market. Our different charts, we're turning more negative with the Heikin Ashi. The Kegi is positive with a black line, but it is pointed down. The Renko is still positive, and the 3-line break is still positive. Our other indexes, the equal weight is really underperforming the S&P 500. We're still seeing some negative divergence when we look at traditional Dow theory, where the Dow had tried to come back up to previous levels. That did not happen with the transports. The utilities were hanging in there, but now are showing a lot of weakness. Then our new take on Dow theory, we're still above this resistance level right now with the S&P. Even though we've fallen back down with the NASDAQ, we're still above this resistance level. The transports continue to underperform the Dow. When we look at this chart, it just shows that the big stocks are really outperforming the smaller stocks. The Dow came down to its 200-day moving average. So far, that is providing support. The diamonds remain at negative. The NASDAQ, after topping out, has been coming back down. Will it find some support at this pivot level? And the NASDAQ may also get some support if we come down to this 38.2 retracement level, which is about 50 to 60 points below where we're at right now. We're still seeing this negative divergence when we compare the S&P to the cumulative new highs minus the new lows on the NASDAQ. The NASDAQ 100 also falling back down. The Qs have switched to neutral. And then looking at the BPI for the NASDAQ 100, after coming right up to this extreme reading, has now been coming back down, but it ticked up just slightly in Wednesday's session. We are falling back down. We're below the 13,614 level now on this chart. This chart is now a few days old. It's giving us a 913.9 reading, which basically just means maybe the NASDAQ 100 is exhausted and due for a pullback, and so far that seems to be what's happening. In the longer term, we're still positive since we remain above this anchored moving average going back to the all-time high. The small caps had another weak day and fell below their 50-period moving average. Then when we look at the Russell 2000, we're coming right down to the 50 with the RSI. The MACD is still positive, but if we see more weakness, this could also roll over. The small caps are showing some improvement compared to the S&P, but they're still underperforming. The Elders Impulse System has switched to negative for the small caps. But when we look under the surface, we're seeing some strength and growth, and it actually ticked up slightly, even though the index has been really under pressure. Now we look at the mid caps. We're below both moving averages now. We drop below this pivot level, so the index itself is showing some weakness. The Elder Impulse System is also confirming that by keeping a red bar. But when you look at this, we compare growth to value. This continues to show some strength and actually ticked up in Wednesday's session. The micro caps were down but still are above 100. The home builders were down just like the S&P, so their relationship is starting to show a little bit more strength. The dollar, this is what I wanted to point out. We're starting to see the dollar try to put in some kind of a rebound. This could put some pressure on stocks. When we were really going up with the dollar in 2022, that did put a lot of stress on stocks. Then when the dollar was coming down, that's when we started to see stocks really go higher. It bounced up. It's now coming back down, but it has been bouncing, so we'll want to keep an eye on that. Then we're also seeing how the S&P 100 continues to outperform the S&P 500, even though both have shown some recent weakness. Keeping an eye on the financial sector, we were down over 1%. The financials continue to underperform the S&P, and the regional banking ETF is showing some improvement when compared to the financial sector. Looking at bonds, interest rates were up where bond prices were down. Then we're also looking at this longer term relationship where it's fallen below the zero level. Looking at the shorter term relationship, it is showing some improvement and the spread is starting to lessen just a little bit. This is a chart that I also posted online where we're starting to break out with the 3-month yield. That's quite short term. It's breaking out to above where it was at back in 2007 into 2008 at the beginning of the great financial crisis. Is this some kind of a warning sign? We don't know for sure yet. There's a lot of things to be worried about. Our interest rate studies were still coming back up when you compare the 1 to 3 month T-bill, which is pretty much cash, with the 3 to 7 year bond looking further out. It had been showing some weakness, enough to give us a death cross with this ratio, but now it's been coming back up. And then we look at the S&P and compare it to the Treasury bond ETF. We're coming back down a little bit. We had been going up nicely, suggesting that we may get a soft landing, but if we see more weakness in this, we'll come down inside the rainbow. Longer term, we're still looking more negative with our special K. We came right up to this red line. That was rejected and turned back down. And then here's our Zohorchak method. It is giving us a positive signal for right now. It doesn't give very many signals. It was negative in 2022 and into 2023, so the fact that this is generating something new could be longer term positive. Our long-term trend, the MACD, is rolling over a little bit, but still above its moving average. As I say every time, it's still suggesting for right now anyway, that this breakout above the trend line is legitimate. An update of our possible positive scenarios. We're seeing some weakness when we look at the 19-day exponential moving average of the advanced decline ratio. We're dropping well below zero based on price and volume. But when you look at growth, look at how it was up slightly on a down day. And overall, it's been performing quite well. When you look at the Qs to the S&P, we're still looking pretty strong there. Discretionary turned up slightly, but it's really been lagging behind, where large cap growth turned down when you compare it to large cap value. Our growth to value ratios, large cap turning down slightly, mid caps down slightly, small caps still looking like they're underperforming. That's why we look at these other charts, because we're seeing strength in the mid and small cap growth, but it's not necessarily being reflected in this chart. Then we also look at the ratio between the S&P and utilities. It ticked down just slightly, but it could be starting to break out, which quite often gives some good support to the S&P. We're still below zero when we look at our 5-period moving average of the highs minus the lows over the broad range of the market, even though it is showing some improvement. And then our 50-period moving average is still holding up okay of the new highs minus the new lows, although our indicator has now dropped below zero. The 2-year Treasury yield, after spiking up and coming down, now it's been coming back up a little bit. Sometimes when this spikes and starts to fall, that gives some short to intermediate term support to stocks, but it hasn't done that yet. This is also looking pretty good. Our staples to S&P 500 ratio, and I actually added a few lines in here, where right now it looks like this is a valid spike and the ratio has been falling. Other times when that's happened, that has led to something good. But be aware of this. When we had a spike earlier this year, notice that the market had already started to go up. This is best when it actually picks some kind of a bottom in the market. So what's our outlook for Thursday? Earnings season is still continuing. I say it's coming to an end, but then I look at the list and it's still pretty long for who's coming out. The technicals are turning more negative. We need to see a good positive day to get out of this negative environment. We have weekly jobless claims coming out. We have the second estimate for first quarter GDP, and then pending home sales will be coming out. Then we have the whole list of geopolitical events. It's pretty much on the debt ceiling right now, and it'll be at the forefront until some kind of a conclusion is reached with that mess. Looking at our stock traders almanac statistics, we are in the week after options expiration. We tend to be more up than down, but so far it's not working out that well. Looking at the day of May 25th, we tend to be neutral to positive with the Dow, and we're more positive with the S&P and the NASDAQ being up 61.9% of the time. And then we're on the 19th trading day of the month where we do see some positive movement in our historical chart. We're also worried about this period coming into May where the green line and the black line do show some weakness after May starts out pretty good. And then when we have a pre-election year, which is the blue bar in here, we do end up being positive for the month. But when you compare May to all the other months, it does underperform. And then this goes back to what happened in 2011 with the previous debt crisis issue, what the market was doing, different events that happened, and then what transpired in the market. This is a chart put out by Shavako Capital, also showing the same thing, where the S&P had done fairly well, saw some weakness, and then really dropped, tried to bounce back up, and then in the latter part of summer really started to fall. Are we going to see something like that this time? So our scenarios, hard to go with the down one right now, even though we are turning more negative, but we're just not trending. Can't really go with the up one because we are turning more negative. So as I've been saying for it seems like indefinitely right now, the ADX is getting stronger, but it's just barely above its moving average, but both are still below 20, and the green line is declining. We had a speech on Wednesday given by Governor Waller, and that's the only scheduled speech that'll be happening this week. So our warning signs, we still have a lot of negative divergences that are kind of all coming together right now. The VIX, even though it's going back up, is still showing a lot of complacency. The NYSE advanced decline line is breaking below the trend line. That's a new one to this list. The NASDAQ cumulative new highs, new lows continue to show weakness, especially when you compare it to the S&P. The S&P is underperforming utilities, but it could be improving. The risk-off posture, we're still in that overall, but it may be changing to more of a risk-on posture. The small cap index is underperforming as well as the mid-cap index, and the mid-caps recently generated a death cross. Earnings season continues, but at some point will actually come to an end. Positive, we have the Copic curve that's generating a buy signal. The Pring bottom fisher, as I pointed out, it may be close to generating a buy signal. The longer-term seasonality and setups, those are still there, and they apply to the whole year. Lower price levels may provide support. If we do really start to scream lower, watch that 4,100 level. That has been significant support in the past. When we hit that in late April and into May, that's when we saw some real buying coming into the market. If we fall to that level, let's see what happens this time. The Nasdaq is still above its resistance, even though it's been falling back. Despite the declines, large cap growth is advancing. That's positive longer term. Small and mid cap growth also is showing some strength. And then will this resolution to the debt ceiling crisis produce some kind of a short-term rally? Right now, it looks like it could. Last week, we were going up just based on hopes. This week, there's a lot of skepticism, and if they finally do get together and reach a conclusion about this, maybe the market will experience some kind of a short-term rally. So our conclusion, the S&P, it's turning more negative now. In the short term, we're turning negative and we're slightly oversold. We're also turning more negative in the intermediate term, but the long term is still positive as long as we stay above the 200-day simple moving average. Thank you. I hope you found this video helpful. I want to welcome all the new subscribers and new participants in the Facebook private group. Also, I'm trying to post more onto Twitter these days. I hope you find that useful. In the meantime, I hope you have a very good day, and I will talk to you in the next video.